Now, today I have a very special guest. We have Zach Wilson with Quest Trust. Zach's going to help us understand the question about the fundamental differences between solo 401ks and your average self-directed IRA. But before we dive into the topic, Zach, welcome to the show. Tell us a little bit about yourself, how you got into the IRA space, and where you're at today.
Absolutely. Thank you so much for having me. I'm super excited about this. We usually, it's not too often we get to speak about it just because not many people realize this is an avenue. So we like to spread the word as much as we can. And we've definitely seen the effects of that over the past couple of years with the popularity growing of people utilizing things like self-directed IRAs. So a little bit about me. I originally got my degree in finance. And so from there, I knew I wanted to get a foot in the door, but I wasn't sure where, just because the thought of simply traditional finance wasn't really something I was, super interested in. And that's where Quest came in. So, when I first joined, I thought, okay, I'll work here for a little bit. I'll kind of test the waters and I'll see where it goes from there. And well, 6 years later, I haven't looked back. It's definitely been a journey. When I first joined, it was on our internal auditing team. So I got to see really how these investments were structured. I got to really comb through the documentation and get a good understanding of them. Then after that, I got to join our IRA specialist team. So now I'm on the front end, seeing the conversations that are being had and the networking and and the relationships that develop that make those deals happen. So I've gotten a really well-rounded picture of kind of the overall process as a whole. And it's definitely changed, how I approach my own personal finances. I can't express that enough, how much I view my own personal savings different just from the knowledge I've gained.
Awesome. Well, I'm so excited for you to be here and share that knowledge with our limited partner investors here today. Well, let's first kind of kick it off. I mean, I know we've talked a lot with our limited partner investors here listening in about what a self-directed IRA is, but I always like kind of catching people up in case this is the first time they tuned in. But I want to answer that question first. What is a self-directed IRA? And then let's talk about what a self-directed or a solo 401k is.
Absolutely. And I love this because I love to demystify really the idea of self-direction, right? So first thing I always like to point out is that term self-directed really is just a marketing term to illustrate you're the one in control of the investments. There's no distinction between a self-directed traditional or a self-directed Roth at a custodian like Quest versus a traditional or Roth you would have anywhere else at like Fidelity or Schwab. Really, the main difference is the custodian themselves. Those custodians allow for you to take those retirement funds, put them into public assets, right? Things like stocks, bonds, mutual funds. Whereas Quest, as a custodian, allow you to take those same retirement funds, but put them into privately held assets. Things like real estate style investments, private lending, private entities, stuff like that. So really, that's the main difference. You're still dealing with the same exact account, regardless of which custodian you're going with.
Mm. Okay, so that kind of gives us a level set definition of the self-directed IRA. Now, what are some other alternatives beyond a self-directed IRA? We'll just stick with that, terminology here, but like, what are some other alternatives here?
Yeah, so when we're looking at as far as like self-directed, right, just be simply being able to issue these funds in the way that you see fit and taking control of them. Obviously, self-directed IRAs are the most common ones. You also have things like your specialty accounts, where ESA, so education savings account, and a health savings account are two alternatives. But by far the most powerful one is, like you stated before, that solo 401k. It's going to be one of the most powerful accounts, honestly, that we have at Quest as well as in the United States. But it comes with some responsibilities, and so that's always the thing I like to share, is to give the well-rounded picture of, hey, it's like Uncle Ben and Spider-Man, right? With great power comes great responsibility, and so it's important to understand both when you're looking at dealing with a solo 401k.
So what are the key differences then between your regular IRA and that solo 401k?
So the first thing that catches people's attention whenever they're looking at a solo 401k really is going to be the contribution limits, because they're substantially higher when it comes to the solo 401k versus the self-directed IRA, whether it be traditional or Roth. All right. So for example, a traditional or Roth IRA, combined between all of them, right? All of your personal accounts, regardless of how many you have, you're able to contribute up to 7,000 for the year 2024. And if you're over 50, that bumps up to 8,000, right? Alternatively, for the solo 401k, your maximum contribution can reach upwards of 69,000 in a single year. Now, I'll expand on that a little bit, because it's obviously you have to meet some requirements to get to that level, but it allows for a much heavier contribution, and that can be both for you and your spouse each maxing out, right? So the contribution limits are the first thing that really catches people's attention. But the second is understanding really the role that you'll play when it comes to each account. Right? So first, with the traditional IRA, I'm sorry, with an IRA really in general, Quest is a trustee, right? As the trustee, what are we doing? Well, we're going to set you up with a portal. That means we have responsibilities for doing all the bookkeeping and the record keeping for all the investments made within the account. Right. We're also going to show you all of your transactions. You're going to be able to take distributions, request them through us, and then we're going to deploy the funds out, and also we'll generate the tax forms, right? So any 5498s or 1099Rs, we're going to be generating and sending to the IRS as well as to you on behalf of the IRA. So we're very hands-on as a custodian when it comes to the IRA. Now the 401k is much, much different, right? When it comes to the 401k, you are the trustee. We are simply the plan document provider. So we'll help you set it up, right? So we'll help you set it up, but then from there, as the trustee, right? Or you can elect someone else to be the trustee, but simply it's just not going to be Quest. As the trustee, that person, right, whoever it is, would need to then apply for the EIN. They're going to set up the checking account that's going to be associated with that 401k, whether it be one checking account or multiple. You know, most people will suggest if you're having different buckets, you want multiple just for bookkeeping purposes. From there, also, you're going to be handling all the investments, which means properly vesting them under the name of the 401k. It also means, hey, you're going to be generating the tax forms, your 5500 or your 5500 EZ, as well as your 1099s when applicable. Right. So that's where that great responsibility comes in, because all of that is resting on the shoulders of the trustee. Now, we do have a software, you know, that we did develop that kind of houses that all in one system, but it's important to understand that, well, you still have to take care of that whenever you're being, whenever you're operating within a solo 401k. And then finally, the contributions on how they get in there. All right. So very straightforward with your personal accounts. You as the individual, if you've got compensation, right, you qualify unless you're over the income limit to make contributions to both your traditional and your Roth, right? And we can break that down if anyone has questions, kind of take a look at that. But simply you're making the contributions, right? They're potentially tax deductible in the case of a traditional, and then they're after tax in the case of a Roth. Well, with the 401k, you're wearing two hats. You're wearing both your employer hat and your employee hat. So as the employer, right, you're making contributions of up to 25% of what you pay yourself if you pay yourself W-2 income, or yourself if you pay yourself 1099 or Schedule C income, right? Those contributions always have to be made pre-tax, right? As the employer, that's the responsibility, or I'm sorry, that's the requirement, is that your contributions always going to be pre-tax. Now, the second hat that you're wearing is the employee hat, right? This is you as the individual. Well, you as the individual are able to contribute up to 23,000 for 2024, and if you're over 50, it actually bumps up to 30,500. Right now, you can choose to put that in there, traditional or Roth. So that's up to you. It's still housed within the solo 401k, but you'll have different buckets within the solo 401k, accounting for your traditional funds, your after tax, your Roth funds, your profit sharing funds, right? So it gets a little bit more complex as to how the funds are getting in there and the implications that can have on the taxation of any distributions coming out. All right, so that's kind of the main key differences. Finally, as far as the solo 401k, solo 401k has a little bit more freedom when it comes to the investments that it can make, right? The IRA as a whole can make all the same investments, but they're usually restricted by the custodian. You know, like I said before, Quest, we're going to handle your private assets, but we don't handle your public assets. Fidelity or Schwab, any of them, simply going to be the opposite. They handle the public assets, but not the private assets. In the solo 401k, because you're the trustee, all of that's housed by you and under the 401k and operated by you. So you want to open up a brokerage account under that solo 401k? Awesome, you can do so. You want to purchase a property under that solo 401k? You can do that as well, both being funded from the same account. All right, so a little bit more freedom and ease of access to the funds because you have that built-in checkbook control as the trustee of the 401k. So I think those are the major differences. Obviously, there are some mechanical ones, you know, here and there, but those are more specific to every person's situation.
I love that. And that's probably the most succinct explanation I've heard, like, about the differences between the two accounts. And moreover, like what you say with the solo 401k, like with great, you know, freedom comes great responsibility as well.
Exactly.
And so I know we're going to get the tax question here, but before we get the tax question, I want to, help us understand, how would one go about understanding if which account works best for them, or even if they qualify for either account?
Yeah. So first, let's look at the IRAs, right? So really, in order to qualify for an IRA, you just need earned income. You need to have compensation, right? Usually, it's going to be in the form of like W-2. However, that's not exclusively the only thing that qualifies. But as long as it qualifies as earned income, you're able to contribute to an IRA. Now, when it comes to which one you want to choose, well, the traditional IRA has the potential for tax deductible contributions, right? So it'll lower your income for that year. The funds grow tax deferred. And then when you take them out, you're essentially taxed on those funds as income when you distribute them. Right now, the flip side is going to be the Roth. So the Roth doesn't experience the same the same tax deductibility of contributions because it's a post-tax account. However, within the Roth, it's growing. Now, I always like to draw this distinction. You'll hear people say, oh, it's growing tax deferred or it's growing tax free. Technically, every single retirement vehicle is always growing tax deferred and becomes tax free upon distribution, right? So that's always like to draw that distinction in case anyone gets confused because they hear one way or the other. We'll say, yeah, the Roth by design, what it's meant for is it's growing tax free because when you take them out, the goal is for you to be over the age of 59 and a half and have a Roth open and funded for 5 years to meet that qualified distribution, right? And so that's the strength the Roth has, is the growth within the account and tax-free distributions coming out, right? Now, for the solo 401k, that one, in order to qualify, right? In order to qualify for a solo 401k, one, you need to be a self-employed individual. The reason being is because another name for the solo 401k, it'll be called the individual 401k or the owner only 401k. And what this means is, though, it's designed strictly for businesses in which the owners are the only participants and there are no common law employees. So that's the second qualification, is that you can have no common law employees within the business for that solo 401k that's being sponsored. Otherwise, you would need to set up something like a safe harbor or a traditional 401k. And finally, the third one is what the term we've coined is really legitimizing it, right? When we say legitimizing the 401k, it's within the first year of establishing it, can you make a substantial contribution to that 401k as the employer? All right, because what they want to be sure is that, okay, you didn't just take this account, set it up, like you didn't start, I didn't go to, file with a Secretary of State, establish an LLC, move over my old 401k funds, and now I'm operating in the solo 401k with no intention of actually making contributions to it. I just want the benefits of it. All right, well, it's not designed for that. It's designed to be an employer plan, a fully functional employer plan. And so within the first year, the IRS wants to see that you can make what's called a substantial contribution to that plan. Now, what is substantial? Well, they leave it vague purposely. The reason being is because, well, substantial for a business that has $50,000 in profit versus substantial for a business that has $5 million in profit is going to be, well, really different, right? So as long as you can just say like, hey, this was a reasonable contribution that I can make without putting my business in financial hardship, then usually you've made substantial contribution. All right, so those are the three qualifications you need to meet in order to be qualifying for a solo 401k. Self-employed individual, right? No common law employees, and then a substantial contribution within the first year. Outside of that, really you'll talk to your CPA about, okay, getting the funds in there and what makes the most sense for you, right? Because like I said before, employer contributions always have to be pre-taxed. So the business, that's the benefit it's receiving, is the tax deductibility on those contributions. But you as the employee, well, maybe you want to minimize your taxation. So you're going to try and throw everything you can in there pre-tax to help mitigate that tax burden you have here. Or maybe it's on the flip side. Maybe you think, well, I'm fine with the taxes now. Really, I've got time on my side, and so I want my growth to be maximized. And so if growth is your focus, then maybe putting in a Roth makes more sense for you. Like we talked about before, it is always the it depends, but truly this is one where you really have to take your full financial situation in consideration, right? Your overall game plan.
No, thank you so much for that. Okay, so many questions are swimming around in my head, and I'm sure people who are joining us live have questions too. So I encourage you guys, go over to the Q&A box, drop in your questions. I'll moderate the questions from there. Okay, now my first question is how does somebody who's in real estate or even a passive investor, can they qualify for a solo K?
So it depends, right? So when it comes to the solo 401k, if you are operating under like your own business, like your own LLC, generally speaking, if you're operating as a sole proprietor, it's a little bit harder because that income is considered passive income. Now, this is where like a CPA is really going to come into play. This is me kind of just based off of my exposure to my clients and the conversations that they've had. But if everything is being operated, especially if you're operating as a partnership, um, where it's simply, it's being passed through to the partners, but the entity itself is separate and can then sponsor the 401k. It seems like that's the best recipe for it. But I'm sure it would depend on the type of income you have, right? Is it passive income? Is it active income? That'll all play factors into, are you eligible to contribute to the 401k?
Awesome. And then it sounds like there's two different sets of rules here from the IRS between an IRA and a solo K. Is that the case? Do they fall under two different areas of the tax law? Is that why there's such flexibility here?
So it's not necessarily that there's two sets of rules. For example, they're both overseen or well, they're both established under ERISA, right? And then they're governed by things like IRC 4975, which are going to dictate things like prohibited transactions and disqualified parties. But really I think the main difference is it's more of the servicing that the custodian provides as to why you see such a difference in treatment of them, right? With the IRA, it just logistically doesn't make sense for Fidelity to house alternative assets because that's just not how their business is built out, right? They buy and sell securities, which means trading and buying some of these positions over an exchange that can happen very efficiently, but they have systems built out for it, right? Whereas on the other side, we didn't go through all the regulatory requirements to get on the security side. We stuck to the alternative assets and built our business model around that because, well, it actually requires us going through the documentation. Every single investment held here at Quest, right? For all 19,000 some odd clients, every single investment is looked at by Quest employees. We are looking through, we're checking for things like vesting, we're checking for things like blatantly prohibited transactions, which means, I mean, if you don't have a system well built out for that, you can see how that would pile up and just cause delay after delay after delay. And logistically, it just wouldn't make sense. So I think it's more of the custodians who oversee these accounts are what's causing that difference. Whereas, the IRA can invest it. It can go public or private. That doesn't matter. It's just which custodian are you coming with.
All right. We have some questions coming in. A lot of these are kind of more the personal type of situation questions. So we'll save those for our after party session. But guys, keep your questions coming. How does one go about setting up either type of account, the self-directed IRA or the solo 401k?
Yeah, so very simple to set up an IRA, right? You can go to just about any custodian. So for example, at Quest, if you can either talk to an IRA specialist at first, or if you know your game plan, you know which one you're going to be setting up and you're ready to pull the trigger, you can just simply go to the website, to questtrustcompany.com, and up the top right, you'll see the ability to apply for an IRA. You fill out the application online. It takes about 10-15 minutes. And from there, it'll be reviewed by our onboarding team. They're going to check to be sure we've got all the required data, things like your beneficiaries, we've got your driver's license, stuff like that. All right. And then they're going to send it to you for your final signature. You sign that and bring it back to us. So within 24 to 48 hours, you've got an IRA set up that's fully functional. You can move funds in, you can deploy them to a different investment. So it's very easy to set it up, right? And that would go across, I'd say, whether it's public or private, very simple to set up an IRA. Now with a solo 401k, well, first you have to talk to a custodian or an administrator that can actually house that account. Not all administrators will do so. The reason being is because, well, in Quest, for example, we go through a servicer called Pinsco. They're the ones who actually drafted the documentation, right? And we have a partnership with them. Then from there, we have worked with a third-party development team to kind of build out that software, and that's where the application is going to be going through. So you would apply for it there. Then from there, we're going to walk you through how to get your EIN, how to set up the bank account, link them to the platform. So really, it's not necessarily much harder. It just requires a little bit more documentation because you're going into a little bit more in depth because you have to talk about, well, okay, as the employer, am I doing like a profit sharing? Is it deferred comp? What kind of contributions am I making? Or and then as the employer, so sorry about that. And then as the employer, I'm sorry, as the employee, well, you're figuring out, wait, are my contributions, are they traditional? Are they Roth? Am I going to allow for in-plan conversions? Am I going to allow for in-service withdrawals? It's just a little bit more in-depth, but as long as you're talking with someone who will sit there and go through it with you, it's not very difficult.
All right. Well, we have several questions that are kind of piling up that are more like very personally related. But I think one question here in the Q&A chat was like, how can somebody find out about the fee structure associated with setting up either plan?
Yeah, so it's very simple. If you go to questtrustcompany.com, you can actually pull our fee schedule up right on that website. You can always call and ask to speak to an IRA specialist, and we'll walk you through every fee that you'll see. And then we can also send you a PDF of that fee schedule. So it's really widely available just to open up and go view it on there. Same thing for the solo 401k. If ever you can't find it on the Custodian's website, just call and ask. They should be very open to just simply sending you a fee schedule and combing through, that we can comb through exactly what you're looking at as far as costs go. And then, they should be also willing to sit down with you and kind of give you a game plan of like, hey, here's when you're going to see each fee. Here's how you can go about paying it, what to expect, and all of that.
And I want to answer the fees on a global, kind of a more 30,000 foot view level. I know when I speak to investors and I mentioned, this type of, IRA type plan set up, oftentimes I get the pushback. They were like, oh, the fees are so expensive. And I'm like, I don't know. I don't know if
Yeah,
they
right.
are or not. So like, how would you help somebody understand okay, a couple different things. One, the fees that are charged at a custodian such as you versus something, the fees that might be embedded in different accounts, say like at Vanguard, Schwab, Fidelity. And then two, when does it make sense for somebody to set up this type of, more self-directed type of account?
Yeah, so the first address the fees. I think you're absolutely right. I think people, what a lot of times will happen is they will see, especially for example, when you're looking at Quest fee, right? One of the fee schedules that we have whenever you're investing is you'll pay a $350 per asset per year. And at first you see, man, $350 annually, man, that's a lot, right? Well, I could also on the flip side point out, well, okay, well, hey, if let's say you're going into a fund, right? And that fund manager says it's 1% a year. And so you hear, oh, 1%. Yeah, it's a lot easier to swallow, right? Although you got $100,000 in there, their fee, that's $1,000. That's 1%, right? Your fee at Quest, 350, and that doesn't matter. That's a single asset. You got $1 million going towards one asset, still 350 a year. So it's important just to kind of keep in mind how they're being illustrated to you, right? Are you being given a full dollar amount, or are you being given a percentage? Also, when are they going to be applying? So, for example, in that example, right? If you hold that asset, it's charged once a year on the anniversary that you made the investment. That's it. No matter how many transactions having to deal with that account, like let's say you've got a piece of property, right? You got to pay, you've got to pay a contractor, you got to pay utilities, whatever it is. Doesn't change that 350, right? It's just constant there. Whereas, well, if you look on the other side, and some custodians, a lot of them have moved away from more of the hidden fees, right? Because people started to catch on. But I mean, you'll see transaction fees, they'll charge you a percentage of the movement of funds if you're doing that. If you want to close out the account, there's going to be a charge for that. So it's important just to kind of keep a holistic picture of the overall fee structure and when they'll be applied. And how is it being painted to you? Is it being painted up front that this is going to be the maximum you're going to pay, or are you being given the minimum amount? And then when you move in a little bit more than expected, all of a sudden your fee structure is changing. And then as far as the second question goes, when to do it, one thing I always like to point out is that with these accounts, because they are fully self-directed, right, that means they're non-interest bearing. So what you don't want to do is just to blindly move all of your money to a custodian like Quest. And look, as a Quest IRA specialist, this is me telling you, look, don't do it, right? The reason being is because if you come in without a game plan, especially in an environment with inflation as high as it is right now, if that money's not working for you, it's losing value. Right. So you want to have a game plan to come in, right? I'll have consultations all the time where, they're just getting started, just getting introduced to real estate investing as a whole, and they'll want to move their money over. And I often tell them like, hey, well, let's just slow down for a little bit, right? What I think the best step to do would be, hey, let's find your niche, right? What is your niche style of investment? And that's different for everybody. Some people want to be hands-on, so they like the thought of doing a fix and flip or like a rental property. Some people like to be super passive. They want to go into something like a syndication, or maybe they want to go into, just simply private money lending where they can expect, a consistent monthly return. So find your niche. Once you've found your niche, become an expert in it, right? I can't stress enough, dealing in the alternative asset space, these aren't regulated securities, right? They're not as regulated. And because of that, due diligence on the investor side is a crucial step that I think a lot of people overlook. So once you find your niche, you become an expert in that, you know how to do your due diligence, and then you find, okay, here's my potential deal that I'm looking at. Boom. Now we start the ball rolling, because 24 to 48 hours, we can have the account established for you. You can initiate the funds the day that the account is established, right? We say prepare for 2 to 3 weeks. It can happen much quicker than that. Usually takes longer if it's going to be like you're getting closer to the 2 week mark, if it's like a 401k that you're rolling over. But coming from an IRA, I mean, within a week, you can have your funds over and everything's set and ready to go, right? While we're waiting for the funds to arrive, we're starting the investment process. We're doing the full audit. We're gathering the investment documents. Right. So we can work quickly because we're in the real estate space. We know that these deals have limited timelines sometimes. It's not going to be the custodian holding you up, right? That's kind of in quest of you. So we love to help you. We want you to, we want you to have the best experience here. And we find that not being a custodian that is going to chase after you and tell you, hey, let's get you set up now. Let's create urgency so that you move your funds over, that you're going to lose your trust with us, because all of a sudden you're going to move it over and realize, well, my money's not doing anything. At least I could have had it earning interest at, Fidelity. Let's be honest. We're going to have an honest conversation with you. Like, look, once you got that deal lined up, then we start pulling the trigger, because we can move quickly.
Well, and I think you bring up a really good point there. I've run into several investors who have fallen in that trap before, where they set up a solo 401k or 401k, solo 401k, IRA, and then they're like, I have all this money sitting here and it's doing nothing. We have, and you guys can reach out to me directly at Whitney at passiveinvesting.com. We have a note fund to help people in this situation. One, it's a cash flowing investment, but two, sometimes you need like 50, 75, 100K to go into a syndicated asset. If you're sitting on, say, like 25K, or more, we have a note fund that can help you earn interest while you're waiting to kind of grow that pot of money or add additional monies to it to get invested.
Exactly. And I love the idea, honestly, of, especially right now in an environment like there is with higher interest rates. I think debt funds are something that's just incredibly valuable, especially to people, like you said, who aren't necessarily, maybe you're not an accredited investor, or maybe you don't have, the $100,000 minimum that it takes to get into some of these syndications. This allows you to still take advantage of the real estate environment and the overall interest rate environment without having to meet those massive requirements of putting what is potentially your entire life savings into one investment.
Zach, as we wrap up and move to our Ask Me Anything part of the show, two questions. One, what is the top thing that you want investors to walk away with today? And two, how can people best reach out to you?
So the top thing I think is the most important is, I'm gonna say due diligence, honestly, and not just due diligence on your investments, right? Because I feel like that's something that a lot of people kind of, as you're getting into the space, you'll realize how important that is. But due diligence on your custodian, right? Due diligence on your custodian is something that a lot of people overlook. And what this results in is, well, all right, if I Google self-directed IRA and I just go with the first one up there, yeah, they could set you up the IRA, right? But then come time where either you've got an investment that needs to happen quickly and you've got to explain that over the phone with someone, right? Or you've got an investment that's a little bit more complex and you realize you need to actually have a full length conversation with someone that truly understands what this investment looks like. That's where you're going to see the difference in a custodian's quality, right? For example, when you call Quest, we don't have answering machines. We've got someone who picks up the phone for you and they'll be able to have. If not, we've got an entire team of IRA specialists to take that dive with you, right? We were established by investors for investors. So the due diligence on your custodian, making sure that when I need to deploy the funds, when I need to have everything work very efficiently, the custodian can do that and accomplish that for you so that you're not missing on your deal. it's something that I don't think a lot of people put enough time or put enough concentration on, and it's something that you won't find out until it's too late, unfortunately.
And Zach, in wrapping up, how can people best reach out, to Quest if they are interested in setting up account?
Yeah, so like I said, you can always give us a call. You can reach us at 281-492-3434. If you want to, you can just speak to an IRA specialist. It's entirely free to set up a consultation. Either you call in or you can go online and schedule a consultation for a future date and time. If you want to reach out to me specifically, my extension is 3648, or you can just ask whoever answers for Zach Wilson. You can also send me an email at Zachary, that's ZACHARY, Wilson, WILSON, at questtrust.com. And you can send an email over just to the IRA specialist team at IRA specialist with an S at the end at questtrust.com. And so, yeah, feel free to reach out to us in any way.
Awesome.